1-800-952-7729. We're here for the last segment. We were on for a full hour today. WOL 1450 AM and WOL 95.9 FM. 1-800-952-PRAY. 1-800-952-7729 is the number to call. You won't be on the air. You can call me. It'll be off the air. So we're doing a little mini seminar based on the seminars I do at the churches and the senior centers, which is free information without harassment. And we're on what is the difference between a regular mortgage and a traditional mortgage. In a regular mortgage, you have to make payments. You're forced to make payments. And the bank controls those payments and the frequency of those payments. In a regular mortgage, if you make a payment of $1,000, the bank tells you when you must make that payment and how much that was. If that payment goes up, they will tell you it must be going up and you must make it. If you fail to make that payment in a regular mortgage, you will eventually lose your home to foreclosure if you let that happen more than 3 months and then it goes into the foreclosure proceedings. In a reverse mortgage, it's 100% the opposite. You control the payments that are made. Whether you decide to make a payment or not make a payment, you not only control the amount of the payment that's made, but how often that payment is made. And also, and the big difference between a regular mortgage and the reverse is this. In a regular mortgage, when you make a payment, it is bringing down your balance. They have the principal and the interest in there. They apply that payment to both of those, and the balance does go down. In a reverse mortgage, it's exactly the same, but it's a flat interest rate. So you don't have, like in a regular mortgage, where you pay $1,000 and $900 in the first year goes towards the interest and only $100 goes towards the principal. It's the opposite. You have flat interest. So if you're making a $1,000 payment, let's say that flat interest is $500 going towards the principal, $500 will go towards interest. A lot more will go towards the principal, which means in a reverse mortgage, you will pay your loan off more quickly than you would a traditional mortgage if you kept with the status quo and were making payments every month. And secondly, in a regular mortgage, when you make that $1,000 payment, it gets applied towards that balance, the principal and interest. But that's it. You got nothing else to show for it. In a reverse, it's the opposite. Not only does that $1,000 get applied towards the balance, the bank takes that same $1,000 and matches it, not towards your payment, but they take $1,000 out of their own pocket and stick it over to the line of credit. They don't theoretically take it out of their own pocket, but that's kind of how it looks like and how it works. Because in a reverse mortgage, if you make a payment in an open-ended, and there's open-ended and close-ended reverses, two different kinds. But in an open-ended reverse mortgage, you have what's called a line of credit. And as your balance goes down, your line of credit goes up. So if you pay your mortgage down by $1,000, $1,000 also gets applied to your line of credit. And that line of credit is 100% tax-free. And it grows and collects interest in your favor at over 4.5%. So think of it like this. In a regular mortgage, when you're making payments, after you make those payments, you got nothing to show for it except a lower balance. But in a reverse mortgage, when you're making payments like I'm telling you to do, not only are you paying down your mortgage balance, you're obtaining this line of credit that's collecting interest in your favor, that's growing, which is also tax-free. Third, when you make a payment in a regular mortgage, you can't take it back. You cannot call Bank of America and say, hey, oh my gosh, I didn't mean to make that $1,000 payment. I need half of it back because all of a sudden my car went out in the fuel pump and it cost $500. Bank of America, can you send me $500 back? You're going to hear dead silence or not possibly laughter on the phone or click because they're not going to do it. In a reverse mortgage, that $1,000 payment that you made, you can call back and say, I need $500 of it back. And guess what? That $500 comes back also with interest in your favor. It is a mortgage that you completely control, and you need to understand that. That's prime differences between what a reverse is and what a regular mortgage is. But it's all based on what I'm telling you, make those payments. If you decide to not make a payment, then it just becomes something where you don't make a payment and you save all that money up. But know that your balance will go up. If you don't have a mortgage, do you still qualify? Sure. Yes, definitely. The reverse mortgage does not discriminate whether you have a mortgage or not. If you don't have a mortgage, then the chances are you're going to 100% qualify because you got tons of equity in your home. So if you're free and clear and going, but wait a sec, I don't have a mortgage, so why would I do a reverse mortgage? Well, what's the rest of the state of your life like? So you don't have a mortgage, so then I'm assuming you don't have Washington gas bills. You don't have Pepco bills, BGE bills. You don't have food costs. You don't have gas costs, right? You don't have insurance costs, right? You don't have cable bills, right? Wrong. You've got all of those other bills. You might be free and clear on your mortgage, but you're not free and clear on life and the bills that come with it here on earth. So for a lot of people that don't have a mortgage, they're still struggling. Because I know, because I got people that are in a reverse that are not making payments, and they are still struggling just to make it by every single month. The reverse mortgage would allow you to take some of that equity out of your home, and you can pay it back. But at least you don't have to struggle. At least those bills can be taken care of, and at least every single month you're not freaking out how you're going to make it through every single month. So definitely keep that in mind, okay? We talked about how you qualify. Okay, basically what they do is they take how old you are, got to be at least 62 or one of the spouses does. They also take how much you owe on the home and then match that up with what the house would appraise for. And we talked about the percentages. At 62, that's 52% of that appraised value is what you qualify for. But that amount has got to be enough to pay off any existing mortgage. So that $400,000 appraisal scenario we talked about in the last segment, and you qualify for $200,000. If your mortgage is $250,000, you don't qualify for the reverse. You gotta qualify for enough to at least pay off an existing mortgage. If you only owed $125,000 in that scenario, but you qualified for $200,000, then you qualify enough for to get rid of that $125,000 and make payments on your terms, or if ever at all. And you also qualify for $75,000 extra tax-free cash. Remember, the older you are, the more you'll qualify for. Start to finish. Basically, you got a preliminary application, just like in a regular mortgage. You have to go through mandatory HUD counseling, where a licensed counselor is there not to get you to do it, or not there to get you not to do it, but there to fully inform and educate you. They don't do the same thing I do on this show, because they don't have that kind of time. But they go through the basics to make sure you understand, but they don't emphasize the things I do about making payments and stuff like that. Then you have an appraisal. Then you have the final underwriting. Okay, so it's a 4-step process, not too shabby. What mortgage brokers and banks don't want you to know about the reverse mortgage? First and foremost, closing costs. They don't want you to know that the closing costs that they're telling you are so high don't actually have to be that high. Don't get me wrong. They are there. Those closing costs are still there. But they don't want to tell you basically that you, the homeowner, doesn't have to incur all those closing costs. Now, in a reverse mortgage, every closing cost is financed in the loan. So there's none of that out-of-pocket back-end money like when purchasing a home. It all gets financed in there. But what the banks don't want you to know, and other loan officers don't want you to know, how much we get paid. Because if you knew how much we get paid, you'd say, hey, can you break me off some? My closing costs you're telling me are $20,000. Can you knock that down for me with some of that fat money that you're getting paid? We used to get paid a lot more before that election happened, okay? And it used to be to where for everybody, not only if you already had a reverse where they zero closing costs, for a lot of people, I was knocking down closing costs from $28,000 down to like $4,000. Can't do that anymore because we don't get paid as much once that election happened, okay? But we still get paid enough to where we can knock down a lot of those closing costs. interest rates, adjustables and fixed rates, it's the opposite of what you think. In a fixed rate, you want a fixed rate when you're in a regular mortgage making payments. But when you're in a reverse, it's the opposite. You want fluctuation because the adjustable is half. It's pretty close to half of what the fixed rate is. That's what it starts out at. And in a fixed rate reverse mortgage, you leave money on the table because federal rule establishes that you only qualify for a certain amount of money. And that amount, since 2013, they break it off into 2 separate years. One at closing and one on your anniversary 365 days later. So in a reverse now, keep this in mind. If you qualify for $100,000, they're going to separate that into $50,000 up front and $50,000 into the second year. Okay? But in a fixed rate reverse mortgage, it only qualifies for a lump sum payment up front. And you're forced to take all of that money, even if you don't need it. If you didn't need $50,000, you got to take all $50,000 in a fixed rate because that's the way it's designed. So your balance went up by 50 grand like that, right out of the gate. That's horrible. But in a fixed rate, there's no second year money. There's no anniversary 365 days later. So that $100,000 was only broken up into a $50,000 payment for you. The other $50,000, you lose. And an adjustable, you get both. You got to call me for further explanation. We're going to talk about that next week also in depth. 1-800-952-PRAY, 1-800-952-7729. Give that number to a friend of yours. It'd be great for a seminar, valuable information. To God be the glory. Go out and make it a good one. Let people see Jesus.